Welcome to the Pro Ticker Deep Dive.
Glad to be here for this one.
Yeah, and it is a big one. It is March 2026, and I think we need to just put it out there right away. If you are feeling a severe case of macroeconomic whiplash every time you look at the news, or, check your portfolio.
Yeah, absolutely not alone.
Exactly. You are not alone. We are sitting at what feels like one of the most confusing, multidimensional pivot points in modern economic history.
It really is. The signals flashing across the dashboard right now are just completely contradictory.
Yeah, it's like we're trying to navigate a foggy jungle and we don't have a working compass.
That's a great way to put it. The traditional leading indicators, the things that have guided asset allocation for the last 40 years, they are either breaking down completely or they're sending signals that just totally contradict the reality on the ground.
And you see that friction everywhere. On one side, we have this absolute unbridled euphoria surrounding artificial intelligence. I mean, equity markets are heavily concentrated, the indices are hitting all-time highs, and corporations are pouring hundreds of billions of dollars into AI infrastructure.
It feels like we're entering a new industrial revolution.
But then, on the exact same day, in the exact same economy, we are witnessing a sudden, absolute freeze in the job market.
Yeah.
Plus relentless geopolitical shocks overseas and this stubborn, sticky inflation that just refuses to return to the target rate.
The divergence between Wall Street and Main Street has always existed, but right now,
Yeah.
right now it is a chasm.
A total chasm.
You have asset managers celebrating these historic valuations, while corporate hiring managers and everyday workers are gripped by this paralyzing anxiety. And the hardest part for anyone trying to allocate capital, plan a career right now, is that both of these perspectives are entirely justified by the underlying data.
Which brings us to our mission for this deep dive. We are stepping into that foggy jungle for you. We want to cut through the noise and decode this multidimensional polarization.
It's a bizarre environment. Massive technological growth colliding with a frozen labor market and tight monetary policy.
Exactly. And we are going to figure out what this actually means for you, because understanding macroeconomic theories in a vacuum, that's useless.
Completely useless unless you can translate it into actionable strategies.
Right, for your portfolio, your career trajectory, your financial planning.
So we need to look under the hood of the latest data releases, strip away the sensationalist headlines, and identify the actual structural shifts happening beneath the surface. The goal is to move past the panic and find the signal.
Okay, let's unpack this right out of the gate with the bombshell economic data that just dropped.
The February 2026 jobs report.
Yeah. Going into this release, the consensus expectation across the board was that the economy would add roughly 60,000 jobs.
Right. Nobody was expecting a blockbuster month, but we anticipated modest, stabilizing growth.
But instead, the floor just completely fell out. The economy lost 92,000 jobs.
92,000.
We went completely backwards, and the national unemployment rate ticked up to 4.4%.
And to make matters worse, the pain wasn't isolated to February. We saw severe downward revisions to the previous month's data, too.
Right, December and January.
Exactly. Combined, they were revised downward by 69,000 jobs.
Wow.
So that prevailing narrative we had in early January, the idea that the labor market was achieving a soft landing and stabilizing, that has essentially been wiped out by these revisions. The downward momentum took hold much earlier than the initial data suggested.
Losing nearly 100,000 jobs in a single month is the kind of headline that traditionally sends markets into a total tailspin.
It makes people want to liquidate everything to cash.
Exactly. But looking at the structural components of this specific report, it's clear the headline number is masking some massive localized distortions. We are not looking at a broad-based systemic collapse of the labor market just yet.
No, we aren't. And what's fascinating here is the microanatomy of that 92,000 job loss.
Break that down for us.
When you parse the establishment survey, you immediately see the anomalies dragging the aggregate number down. First and foremost, the healthcare sector shed 28,000 jobs.
Which is wild because for the last 2 years, healthcare has been the undisputed engine of payroll growth.
Consistently adding upwards of 30,000 jobs every single month. So to see it suddenly contract by 28,000 requires looking at external events.
The strikes.
Exactly. It was driven almost entirely by a massive labor strike involving tens of thousands of Kaiser Permanente nurses and frontline medical workers out in California and Hawaii.
And because of the way the Bureau of Labor Statistics collects this data, if a worker is on strike and not receiving a paycheck during the specific reference week of the month when the survey is conducted,
They are counted as a job loss.
even though they haven't actually been permanently laid off.
Right. They are completely omitted from the payrolls for that month. It's a temporary optical illusion in the data. Once the strike is resolved and those nurses return to their shifts, those 28,000 jobs will magically reappear in a future payroll report as a massive gain.
Got it. And then there was the weather factor too, right?
Yeah, if you look at the construction sector, it registered a loss of 11,000 jobs. This was heavily impacted by the severe, unseasonably frigid winter weather systems that swept across the country in February.
Literally freezing large-scale infrastructure and housing projects.
Exactly. Add to that the 17,000 jobs lost in the logistics and courier sector, which is largely a delayed post-holiday cooling effect.
E-commerce demand dropping off after the winter holidays.
Yeah, the logistics networks just shed their seasonal headcount. So when you aggregate the strikes, the deep freeze, and the seasonal package delivery hangover.
A highly significant portion of that 92,000 headline loss is totally transitory.
It completely changes the complexion of the report. It prevents that immediate reactionary panic that usually accompanies a negative payroll print.
I hear that. And stripping out the transitory noise is vital for accurate modeling. But playing devil's advocate here, if we keep stripping out the anomalies month after month, aren't we just making excuses for a fundamentally deteriorating economy?
That is a very fair point.
I mean, we can't blame everything on the weather and labor disputes when there is a very clear systemic rot showing up in the cyclical sectors.
That is the crucial counter-narrative, and it is entirely valid. We cannot ignore the structural weakness bleeding into the core economy. Manufacturing, for instance, which is traditionally highly sensitive to interest rates and demand cycles, contracted for the 14th time in the last 15 months.
Shedding another 12,000 jobs?
Exactly. And even more concerning, the professional and administrative services sector.
The white-collar engine of the economy.
Right. It shrank by 19,000 jobs. So beneath the localized distortions of strikes and snowstorms, the fundamental hiring engine of corporate America is definitively stalling out.
Which brings us to this incredibly bizarre paradigm we are seeing across the corporate landscape right now. Economists are calling it the low-hire, low-fire equilibrium.
Yes, we are essentially trapped in a state of corporate paralysis.
Usually when you see negative aggregate payroll numbers, it's accompanied by a spike in initial jobless claims. Companies see demand dropping, they panic, and they initiate mass layoffs to protect their margins.
But that classical reaction function is broken right now. Mass layoffs remain historically low. Instead of slashing headcount, companies are hoarding the workers they currently have,
Treating them like irreplaceable assets.
while simultaneously refusing to open up new requisitions to hire anyone else.
It is a total deep freeze. And here's where it gets really interesting. Despite the fact that the broader economy just lost jobs, and despite corporate hiring budgets being frozen solid, wage growth is still running hot at 3.8% year over year.
Which is wild.
Traditional economic model suggests that when hiring stops, wage growth should plummet because the competition for labor disappears. But we are seeing the exact opposite.
And the mechanism driving that 3.8% wage growth is entirely defensive. It comes down to retention premiums.
Right.
Because executive teams are terrified of the frictional costs associated with losing talent, the institutional knowledge drain, the massive expense of recruiting, onboarding, and training a replacement in a market where their own HR budgets are frozen.
So they are willing to pay a heavy premium to keep their current staff happy and in their seats?
Exactly. They are essentially paying defensive wages to prevent their employees from testing the open market.
Think of like a mid-level software engineer or a senior supply chain analyst.
Yeah.
Their company might have zero intention of expanding their department, but if that analyst threatens to leave,
Management will suddenly find the budget for a 5 or 6% raise just to maintain the status quo.
they are buying stability.
The cost of a 4% retention raise is viewed as significantly cheaper than the operational chaos of a vacant role that management won't allow them to backfill.
So what does this all mean for you, the listener, as you navigate your own career and financial planning in 2026? The labor market dynamics have completely decoupled depending on which side of the firewall you are standing on.
The leverage in the labor market right now is entirely asymmetric. If you are currently employed and you possess critical institutional knowledge or specialized skills, you actually hold a surprising amount of leverage.
You have the ability to negotiate a raise, better benefits, or remote work flexibility with your current employer.
Precisely because they're operating in this low-fire, talent-hoarding mindset. They desperately want to avoid the friction of replacing you.
But if you are on the outside looking in, if you are a recent graduate, if you were caught in one of the localized tech layoffs last year, or if you are simply trying to pivot into a new industry,
You're running face first into a brick wall.
yeah.
The low-hire reality means that organic job postings have slowed to an absolute trickle. The roles that are posted often have hundreds or thousands of applicants within hours.
And the interview processes are stretching out for months as management teams agonize over every single headcount addition.
For job seekers, the traditional method of firing off resumes into online portals is practically useless in this environment. It requires an aggressive pivot toward direct networking, utilizing secondary connections, and targeting contract-to-hire roles just to get a foot in the door.
That is a brutal reality check for anyone trying to gain upward mobility right now. And speaking of reality checks, this upward drift in the unemployment rate to 4.4% forces us to confront a macroeconomic concept that has been the singular obsession of bond traders and central bankers for the past year.
The SAM rule.
We have to dissect the SAM rule.
The SAM rule has been the protagonist of the most dramatic economic subplot of this entire business cycle.
For context for our listeners, it was developed by former Federal Reserve economist Claudia Sam, and it has served as a historically flawless real-time indicator for the onset of a recession.
The formula is elegantly simple. If the 3-month moving average of the national unemployment rate rises by half a percentage point, so 0.5% above its lowest point over the previous 12 months, the economy has decisively entered the early stages of a recession.
And when we say flawless, we are looking at a track record that stretches back to 1949 without a single false positive.
Not one.
It has never missed a recession, and it has never triggered without a recession following. That is, until the chaotic economic environment of this current cycle completely broke the model.
The trajectory of the SAM rule over the last 8 months has been completely unprecedented. Back in August of 2025, the rule officially triggered.
It breached the threshold and hit 0.57%.
Right. Historically, that print is the ultimate klaxon alarm. It signals to institutional investors that a demand collapse is underway and a recession is unavoidable.
But instead of cascading into a contraction, the economy simply defied gravity.
The rule miraculously untriggered. The moving average steadily fell back down to 0.4%, and with this recent February 2026 data, it currently sits at 0.27%.
Which begs the question of how an indicator with an unblemished 75-year track record suddenly misfires.
Exactly.
Because the fundamental mathematics of the rule didn't change, which means the structural composition of the labor market beneath it must have warped completely.
To understand the false positive, you have to look at the numerator and the denominator of the unemployment rate calculation. The SAM rule was fundamentally designed to detect demand-side recessions.
Right.
In a normal cycle, the rule triggers because companies are aggressively firing workers. The numerator, the absolute number of unemployed people, skyrockets because existing jobs are being destroyed.
But the trigger in late 2025 wasn't driven by job destruction.
No, it wasn't.
It was a massive supply-side shock.
Precisely. We experienced a historic, unprecedented influx of immigration, coupled with a massive wave of previously sidelined domestic workers re-entering the labor force just before new restrictive labor policies took effect.
So the economy was still actively creating jobs.
Yes, but the absolute velocity of labor supply entering the market vastly outpaced the economy's ability to absorb them. The denominator expanded so rapidly that the unemployment rate mathematically had to rise, even though the core engine of the economy was still growing.
Claudia Sam herself stated that her rule was basically designed to measure demand weakness, and it was practically guaranteed to break under a massive supply shock of that magnitude.
So the August 2025 trigger was essentially a sensor glitch caused by a sudden influx of new participants. We dodged the recessionary bullet.
But as we look at this new February 2026 data, with the unemployment rate creeping back up to 4.4% and the job market freezing, it feels like the nature of the threat has mutated.
What's fascinating here is that the mechanics of the danger have completely inverted. The supply shock is definitively over. Net immigration has been drastically curtailed, and labor force participation has plateaued.
So the current upward pressure pushing unemployment toward 4.4% is entirely demand-driven.
Yes.
Huh.
This is the manifestation of the low-hire freeze we just analyzed. The fact that the rate is rising now means the actual engine of economic growth is struggling to maintain its altitude.
It is the perfect check engine light analogy.
Right.
Last year, the light flashed on your dashboard because you poured a massive amount of experimental high-octane fuel into the tank, and the sensors simply didn't know how to process the sudden change in chemistry. The car itself was running perfectly fine.
But this year, the check engine light is flickering back on because the transmission is actually starting to slip.
We are creeping back toward that 0.5% trigger threshold, but this time the underlying mechanics are highly non-benign.
This structural strain is real, but it is vital to disconnect the concept of an economic recession from the performance of the equity markets.
Because assuming they move in tandem is one of the most common and costly mistakes an investor can make.
It is the ultimate counterintuitive Wall Street maneuver. Main Street sees the SAM rule trigger, anticipates a recession, and panics. Wall Street sees the SAM rule trigger, anticipates the Federal Reserve stepping in to save the day, and immediately buys equities.
Yeah, historically, even when the SAM rule legitimately triggers and a recession is declared, the S&P 500 averages a 10% to 17% gain over the following 12 months.
Because the market is a forward-looking discounting mechanism. When the economy slows down and unemployment rises, the immediate expectation is that the Federal Reserve will pivot aggressively.
They'll slash interest rates to the floor and flood the financial system with cheap liquidity to stimulate growth.
Lower interest rates drastically reduce the borrowing costs for major corporations, instantly expanding their profit margins. Furthermore, lower rates make the fixed yields on government bonds less attractive,
Which forces massive amounts of institutional capital further out on the risk curve directly into the stock market. Which brings the entire macroeconomic puzzle to the doorstep of the single most important institution in the world right now, the Federal Reserve.
They are currently attempting to navigate one of the most perilous, contradictory policy tightropes in their history.
The Federal Open Market Committee is currently holding the benchmark interest rate steady in a range of 3.50% to 3.75%.
Right. They executed 3 distinct rate cuts in late 2024 and 2025 to head off early signs of labor weakness, but they have recently slammed on the brakes.
They are completely paralyzed by a classic dual-mandate macroeconomic trap.
The parameters of that trap are excruciating. On one side of the ledger, you have the severe labor market freeze we just spent the first half of this deep dive dissecting.
A loss of 92,000 jobs, an unemployment rate drifting up to 4.4%, and core manufacturing contracting.
In any normal historical cycle, the Fed's immediate playbook would be to slash interest rates to cheapen capital and stimulate corporate hiring.
But on the other side of the ledger, you have inflation.
And inflation is proving to be incredibly resilient and sticky.
It is hovering stubbornly around the 3% mark, which remains significantly elevated above the Fed's mandated 2% target.
And crucially, there are entirely new structural macroeconomic pressures coming online this year that threaten to push that inflation rate even higher.
To understand these inflationary pressures, we really have to look objectively at the major policy shifts currently being implemented. We're looking at this purely through the lens of economic mathematics.
Right.
Without taking any political stance on the merit of these policies, we just have to model their mathematical impact on prices.
Absolutely.
First, we have the broad implementation of reciprocal tariffs on imported goods. Currently, we are seeing effective tariff rates sitting near 11%, with some market projections hoping that judicial intervention or new legislative frameworks might bring that down to 7.5% by the end of the year.
If we connect this to the bigger picture, tariffs operate as a direct consumption tax. When a 10% or 11% tariff is levied on a container of electronics or raw industrial materials entering the port of Los Angeles, the foreign manufacturer doesn't pay that tax.
Right, and the domestic importing company rarely absorbs the cost into their own margins either.
They pass that increased cost directly down the supply chain until it hits the end consumer at the retail level. So you have immediate, mathematically unavoidable upward pressure on goods prices.
And at the exact same time, we're witnessing severe structural cuts to net immigration, which has been brought down to roughly 250,000 arrivals per year.
Which is a massive contraction compared to the historic averages of over 1 million.
Again, looking at this purely as a mathematical formula of supply and demand, when you aggressively shrink the available pool of labor, But the domestic demand for services, construction, and agriculture remains constant. The price of that labor has to increase.
The competition for the remaining pool of domestic workers intensifies, forcing wages higher in those lower-margin service sectors. And when service sector wages rise, those businesses have to raise the prices of their services to maintain profitability.
Which feeds directly into the sticky service sector inflation the Fed is already struggling to contain.
So the Fed is trapped in a vice. They are staring at a cooling labor market that desperately needs the relief of interest rate cuts.
But they are simultaneously modeling the inflationary impacts of 11% tariffs and severe labor supply constraints, which dictate that interest rates must remain high to cool down consumer demand.
It is an agonizing balancing act, and it's made infinitely more complex by the massive leadership transition looming on the horizon.
Federal Reserve Chair Jerome Powell's term officially expires in May 2026.
The succession planning is already dominating institutional chatter, and the primary name being floated to take the helm is Kevin Warsh.
And the potential transition from Powell to Warsh is not just a change in personnel. It is a fundamental shift in monetary philosophy.
Warsh is widely perceived by the bond markets as a deeply hawkish figure.
In the lexicon of central banking, for those listening, a hawk is a policymaker who prioritizes the eradication of inflation above all other economic considerations.
Right. A hawkish Fed chair is generally willing to maintain high interest rates and endure significant pain in the labor market, even risking a mild recession if it means successfully breaking the back of inflation and returning to that 2% target.
Whereas Powell, while he has certainly raised rates, has historically leaned slightly more dovish, trying to thread the needle of a soft landing to protect jobs.
Warsh is viewed as someone who would tolerate much less ambiguity on the inflation front.
So, what does this all mean? If you are an institutional investor trying to build a 5-year financial model, how do you possibly price in a frozen labor market, stubbornly sticky inflation fueled by new trade policies, and a potentially hawkish new Fed chair who might refuse to cut rates even if unemployment hits 5%?
You protect your capital by demanding a massive uncertainty premium.
Yep.
When the macroeconomic visibility is this poor, capital allocators demand higher yields to compensate for the risk they are taking. You can see this exact dynamic playing out in real time in the sovereign bond market, specifically the 10-year Treasury yield.
With the 10-year Treasury yield coiled tightly around 4.16%, that acts as a massive gravitational pull on the valuation of every other risk asset in the world.
The 10-year yield is the ultimate undisputed barometer for global financial health. It is the foundational risk-free rate upon which the entire capitalist system prices debt and equity.
It dictates the mortgage rate for a family buying a home in Ohio, and it dictates the cost of capital for a multinational corporation building a factory in Mexico.
Exactly. When the 10-year yield anchors itself above 4% and refuses to drop, it is the bond market screaming that the era of higher for longer interest rates is a permanent structural reality, not a temporary blip.
And mathematically, higher risk-free yields compress the valuation multiples of the stock market.
Which brings us to the most spectacular contradiction of this entire economy.
Oh, this is the part that blows my mind.
Because while the broader traditional economy is buckling under the weight of 4% bond yield, frozen hiring, and inflation, there's a specific sector of the market that has achieved complete escape velocity.
They are completely ignoring the gravitational pull of high interest rates. Analysts are defining this current state as severe multidimensional polarization.
Multidimensional polarization is the academic framework for what we colloquially call a K-shaped recovery.
If you visualize the letter K, the vertical line represents the starting point of the economy. From there, one arm shoots sharply upward at a 45-degree angle, achieving massive growth and prosperity.
And the other arm angles sharply downward, representing contraction, distress, and insolvency. The economy is violently splitting in two divergent directions simultaneously.
Okay, let's dissect the arm of the K that is shooting straight up into the stratosphere. We are living through an absolute, relentless artificial intelligence supercycle.
The concentration of wealth and market capitalization at the top of the S&P 500 is staggering right now.
The tech hyperscalers, the specialized semiconductor designers, the utility companies retrofitting the grid to power these massive data centers, and the high-end logistics firms moving the physical infrastructure.
These companies are operating in a completely different reality. They're posting massive, above-trend earnings growth of 13% to 15% quarter after quarter.
The sheer scale of the capital expenditure, The hundreds of billions of dollars being deployed in real time to build out next-generation AI infrastructure, the sprawling, liquid-cooled server farms, the dedicated nuclear power agreements, it is historically unprecedented.
Crucially, these apex corporations are wildly cash-rich. They generate tens of billions in free cash flow every single quarter.
Therefore, they are virtually immune to the 4% bond yields that are crushing smaller competitors because they don't need to borrow money from the bank to fund their expansion.
They self-fund their growth. They are the ultimate has in this multi-dimensional polarization.
But then you look at the lower arm of the K, the have-nots, the legacy industrial companies, the mid-market retail chains, the commercial real estate operators.
And for them, 2026 is bringing an existential, terrifying reality, a massive, unavoidable $1.5 trillion corporate debt refinancing wall.
$1.5 trillion.
Yes. This raises a profound question about the survival rate of the broader corporate landscape over the next 24 months.
If we rewind the clock back to the zero interest rate phenomenon of 2020 and 2021, corporations binged on incredibly cheap debt.
They issued billions of dollars in corporate bonds, locking in interest rates of 3% or 4%, usually on 5-year maturity terms. Well, those 5-year terms are expiring right now in 2026. The principal is due.
And these companies don't have the cash to pay off the principal, so they have to roll the debt over. But they can no longer refinance that debt at the 3% fantasy rates of 2021.
They have to refinance it at the harsh reality rates of 2026, which, because of the Fed's higher for longer stance, might be 7%, 8%, or even 9% for a company with a shaky balance sheet.
The mathematics of that rollover are catastrophic for corporate profit margins. Imagine a mid-sized consumer goods company that has been comfortably servicing a $500 million debt load, paying roughly $15 million a year in interest.
When they hit the refinancing wall this year, their interest rate doubles.
Suddenly, they have to pay $35 or $40 million a year in interest just to maintain the exact same amount of debt.
That additional $25 million in interest expense comes directly out of their net income. It completely vaporizes their profit margin, turns them from a profitable enterprise into a loss-making one, and forces them to slash capital investment and freeze hiring just to survive.
And the credit markets are watching this slow-motion train wreck unfold in real time, which is why we are seeing high-grade corporate spreads widening significantly.
Jumping by over 110 basis points in recent weeks.
And for those listeners who don't spend their days staring at bond trading terminals, when spreads widen by 110 basis points, it means the interest rate penalty, the extra yield that these riskier corporations have to pay compared to ultra-safe U.S. government bonds, has spiked by 1.1%.
The bond market is aggressively pricing in the risk that a massive wave of these have-not companies are going to default on their debt because they simply cannot afford the new interest payments.
It is a brutal Darwinian culling of the corporate herd. Meanwhile, the AI-adjacent haves are using this exact moment to actually re-leverage their bulletproof balance sheets.
They are aggressively taking on new debt to fund massive mergers and acquisitions, buying up distressed competitors at a discount.
Because their AI-driven profit margins are so astronomically high, they can easily absorb the higher interest rates.
The multidimensional polarization accelerates, the rich get richer, and the highly leveraged get crushed.
This massive divergence brings us to a macroeconomic concept that I found deeply unsettling yet undeniably fascinating when researching the current state of the labor market. The emergence of technological structuralism and the terrifying reality of the jobless boom.
This is perhaps the most profound structural shift we are witnessing in the 2026 economy. We discussed earlier that companies are terrified to hire new workers, locking the labor market into a deep freeze.
Right.
But the obvious question is, how are these companies maintaining their output and hitting record profitability if they are refusing to expand their human workforce?
And the answer is that the billions of dollars poured into AI over the last 3 years are finally generating real, measurable productivity gains at the enterprise level.
Think of a mid-sized financial services firm. In 2023, if they wanted to expand their compliance department to handle a surge in regulatory filings, they had to go out and hire 10 junior analysts.
Today, in 2026, they simply purchase an enterprise-grade AI compliance software license, retain their 2 senior managers to oversee the output, and the AI handles the workload of the 10 junior analysts in a fraction of the time.
The productivity gains are undeniable and accelerating. Executive boards are realizing that they can drastically increase their operational output and subsequently inflate their profit margins without incurring the massive compounding expense of human headcount.
They are actively substituting future human labor with scalable AI infrastructure.
And this directly manifests the jobless boom. The stock market indices soar to record highs precisely because corporate profits are exploding.
But why are profits exploding? Because corporations have found a way to permanently sever their biggest historical expense, human payroll expansion, from their revenue growth by utilizing AI.
It creates a deeply unsettling macroeconomic paradox. The stock market is enthusiastically celebrating and rewarding the exact same technological shift that is making it nearly impossible for a young college graduate to find an entry-level position.
The efficiency and profitability of the mega corporation have become completely decoupled from the economic prosperity of the average median worker.
It perfectly encapsulates why consumer sentiment surveys are printing at dismal recessionary levels, while the S&P 500 is printing all-time highs.
You open your brokerage account on your phone and you feel like a financial genius, but you open your professional networking feed, see endless posts about hiring freezes and impossible interview loops, and you feel terrified for your livelihood.
And this massive domestic structural shift, this jobless boom, is playing out against a backdrop of severe, cascading global instability. We absolutely must pull the lens back and look at the international board, because the geopolitical environment right now is as tense, fragile, and economically dangerous as it has been in half a century.
The epicenter of that fragility is the escalating military tensions and series of kinetic strikes occurring across the Middle East. Specifically, the complex, escalating retaliatory cycle involving the United States, Israel, and Iran.
The physical security of global maritime choke points is degrading rapidly, directly threatening the uninterrupted flow of global energy supplies.
Currently, oil is trading in a volatile range between $74 and $81 a barrel. That is elevated, but it is manageable. However, the true systemic risk currently being priced into the options market is a worst-case escalation scenario where a broader regional conflict disrupts the Strait of Hormuz, causing oil to violently spike to $150 a barrel.
If we model that scenario purely objectively, stripping away the geopolitical tragedy and looking only at the macroeconomic mechanics, a sudden, violent spike to $150 oil is the ultimate nightmare scenario for the global financial system.
It instantly triggers what economists fear most: a severe stagflationary breakout.
Stagflation is the ugliest, most destructive macroeconomic environment imaginable. It is the simultaneous combination of stagnant, collapsing economic growth and rampant, uncontrollable inflation.
And the mechanics of an oil shock guarantee this outcome.
Oil is the master commodity. It is the physical lifeblood of the global supply chain. If the price of crude oil doubles overnight, the cost of transporting every single physical good on the planet, from agricultural produce to consumer electronics, doubles.
That massive input cost is immediately passed to the consumer, causing inflation to skyrocket.
Simultaneously, the exorbitant cost of gasoline at the pump acts as a massive regressive tax on the consumer, draining their disposable income. They immediately stop spending money on discretionary items, which causes retail sales to collapse and corporate revenues to plunge.
Economic growth grinds to a halt while prices explode upward. High inflation plus collapsing growth equals stagflation.
And for the listener who has diligently built a diversified retirement portfolio, why is a stagflationary shock so uniquely catastrophic compared to a normal recession?
Because a stagflationary breakout completely annihilates the foundational mathematics of the traditional 60-40 portfolio.
Right.
For decades, the golden rule of asset allocation has been holding 60% of your capital in equities for long-term growth and 40% in government bonds for safety and income. In a normal recession, this works perfectly.
If the economy weakens and stocks drop 20%, the Federal Reserve cuts interest rates to stimulate growth. When interest rates fall, the value of existing bonds rises, meaning the 40% of your portfolio in bonds goes up, cushioning the blow from your stock losses. They are inversely correlated.
But in a stagflationary shock driven by $150 oil, that inverse correlation breaks entirely. The inflation is so severe that the Federal Reserve is completely paralyzed.
They cannot cut interest rates to save the falling stock market. In fact, they might be forced to raise rates even higher to fight the oil-driven inflation fire.
Which is exactly the opposite of a hedge. Stocks plummet because corporate earnings are collapsing under the weight of the economic slowdown, and bonds plummet because interest rates are staying high or rising further.
Both sides of the 60-40 portfolio take massive losses simultaneously. There is absolutely nowhere to hide in traditional paper assets.
Which perfectly explains why we are seeing massive historic flows of institutional capital fleeing the traditional financial system and seeking refuge in alternative safe havens. Gold has absolutely shattered all historical models, surging past an astronomical $5,300 an ounce.
The parabolic rise in gold is the ultimate manifestation of sovereign fear. It is functioning exactly as it was designed to over millennia, as the ultimate crisis hedge and store of value outside the fiat system.
We are seeing central banks around the world, particularly across emerging markets and the BRICS nations, aggressively hoarding physical gold reserves to protect their national wealth against runaway inflation, U.S. dollar weaponization, and the geopolitical uncertainty radiating from the Middle East.
But beyond the defensive crouch into physical gold, we are also seeing institutional capital actively seeking out surprising pockets of resilience in international equities.
While the United States grapples with its massive AI concentration risk, its frozen labor market, and its sticky inflation, certain international regions are looking incredibly attractive from a valuation and structural growth perspective.
The most glaring example right now is Japan. Japanese equities have suddenly become the darling of international value investors.
The resurgence of the Japanese equity market is one of the most compelling macroeconomic turnaround stories of the decade, and it is entirely driven by a policy framework known as Sananomics.
This is the aggressive structural reform agenda championed by the new Japanese Prime Minister, Sanai Takaichi. To understand its impact, you have to understand the historical pathology of Japanese corporate governance.
Right.
For decades, following the asset bubble collapse in the 1990s, Japanese corporations developed a deeply ingrained deflationary mindset. They hoarded massive, absurd amounts of cash on their balance sheets, refusing to invest in growth, refusing to raise wages, and returning very little capital to shareholders.
They were essentially operating as highly conservative savings banks that happened to manufacture cars or electronics on the side.
Precisely. But Sananomics is fundamentally rewriting that social contract. The government, working in tandem with the Tokyo Stock Exchange, is implementing aggressive corporate governance reforms that practically shame and force these stagnant megacorporations to finally unlock that trapped capital.
They are imposing strict capital efficiency requirements.
So after 30 years of hoarding, they are finally opening the vault and deploying the cash.
They are deploying it rapidly. They are initiating massive domestic capital expenditure projects. They are finally agreeing to substantial structural wage hikes for the Japanese labor force.
Which is generating the first real signs of demand pull inflation and middle-class spending growth in a generation.
And crucially for investors, they are drastically increasing share buybacks and dividend payouts to attract foreign capital. It is transforming a historically stagnant value trap market into a highly attractive, shareholder-friendly environment, providing a vital diversification alternative to the top-heavy U.S. tech sector.
And Japan isn't the only international bright spot. Broadly speaking, emerging markets are demonstrating a surprising level of macroeconomic resilience in the face of all this global turbulence.
The resilience of emerging markets, if we temporarily exclude China from the aggregate data, is a testament to their improved macroeconomic management over the last decade. They are exhibiting fading macro volatility.
In a fascinating reversal of historical norms, many emerging market central banks in Latin America and Southeast Asia actually acted proactively, raising interest rates to fight inflation long before the U.S. Federal Reserve did.
Because they took their medicine early, their domestic inflation is largely under control, and they have actually begun the process of cutting interest rates to stimulate their domestic economies, while the U.S. remains trapped in a higher-for-longer freeze.
Add to that the fact that their equity valuations are trading at massive historical discounts compared to the S&P 500, and they are the primary beneficiaries of the massive global supply chain rewiring, as multinational corporations aggressively move manufacturing capacity out of China and into countries like Mexico, Vietnam, and India to avoid tariffs.
And if we do address China specifically, it remains a highly complex, unique case. The Chinese economy has endured a grueling, multi-year structural slowdown, heavily burdened by a collapsing property sector, massive local government debt, and a crisis of consumer confidence.
However, as we look at the data in the first half of 2026, we are beginning to see undeniable green shoots of stabilization.
Those green shoots aren't necessarily organic growth. They are the result of massive blunt force government intervention.
It is entirely stimulus-driven. After years of incremental, piecemeal measures, Beijing has finally capitulated and front-loaded a massive wave of delayed fiscal stimulus directly into the economy.
They are issuing special sovereign bonds to recapitalize local governments and injecting liquidity directly into the banking system to support strategic manufacturing and infrastructure projects.
While this doesn't solve their long-term demographic or structural debt issues, it is providing a powerful tactical boost to aggregate demand in the short term, which is putting a floor under their equity markets and supporting global commodity prices.
So, synthesizing all of these global dynamics, you have Japan structurally reforming emerging markets, cutting rates and absorbing supply chains, China injecting massive fiscal stimulus, and physical gold skyrocketing as a hedge against Middle Eastern conflict.
Contrast that with the United States, which is wrestling with a frozen labor market, a $1.5 trillion debt refinancing wall, sticky inflation, and a potentially hawkish Fed transition.
Given all of that domestic turmoil, why in the world is the US dollar remaining so incredibly strong against every other major currency? Logic dictates that capital should be fleeing the dollar.
The persistent, ironclad strength of the U.S. dollar in the face of domestic economic strain is the ultimate paradox of global finance, and it is driven by the concept of exorbitant privilege.
The dollar remains strong because, quite simply, it is the ultimate, unrivaled safe haven in a chaotic, multipolar world.
Even if the U.S. domestic economy is showing signs of fracturing, the U.S. Treasury market remains the deepest, most liquid, and most secure financial market on the planet.
When kinetic strikes are occurring in the Middle East or when supply chains are threatened, global asset managers don't run to the euro or the yen for safety. They run to the perceived absolute security of U.S. government debt.
And to buy U.S. Treasuries, you must first purchase U.S. dollars, which creates massive, sustained structural demand for the currency.
It is the cleanest shirt in the dirty laundry basket. Furthermore, the interest rate differential is a massive driver of dollar strength.
Because the Federal Reserve is trapped in that higher-for-longer stance to fight tariff-driven inflation, institutional investors can achieve a 4% to 5% risk-free yield simply by holding cash in short-term U.S. debt instruments.
When you can earn a guaranteed 5% in the world's reserve currency, it acts as a massive vacuum, sucking global capital away from lower-yielding European or Asian assets, which keeps the dollar heavily elevated against its peers.
We have covered an immense amount of complex, interconnected macroeconomic ground today. We have traversed from the micro-distortions of local nursing strikes all the way to the macro threats of a global stagflationary breakout.
Let's try to distill this 60-minute journey into a cohesive framework.
If we synthesize the data, the year 2026 is defined by a delicate high-wire balancing act across multiple dimensions.
We are operating within a frozen, low-hire, low-fire labor market that violently punishes job seekers while rewarding entrenched employees with defensive retention wages.
We are witnessing a historic AI capital expenditure cycle that is physically building the infrastructure of the future while simultaneously creating a brutal K-shaped divergence that threatens to crush highly leveraged legacy companies under a $1.5 trillion debt refinancing wall.
We are navigating a sticky, resilient inflation fueled by shifting trade tariffs and constrained labor supplies, which is forcing the Federal Reserve to hold rates higher for longer.
And overarching all of this is a fragile geopolitical chessboard that constantly threatens to disrupt the energy flows that power the entire system.
So how do you, the listener, actively navigate this environment? First, the current landscape screams for the maintenance of robust, healthy cash reserves.
In a higher-for-longer interest rate environment, cash is no longer the depreciating trash it was during the zero interest rate era. Short-term cash equivalents actually yield a respectable return.
And more importantly, they provide absolutely vital psychological and financial insulation against the unexpected shocks of a highly polarized economy. Whether that shock manifests as a sudden spike in energy prices or an unexpected corporate restructuring that impacts your income.
Second, the data strongly suggests that you need to look seriously at international diversification. The U.S. equity market has become incredibly top-heavy, concentrated in a handful of massive technology conglomerates.
Exploring and allocating capital to regions undergoing profound structural governance reforms like Japan or to emerging markets that offer fading volatility and deeply discounted valuations can provide a crucial, uncorrelated counterbalance to the high beta swings of the domestic tech sector.
And finally, you have to be mentally, emotionally, and financially prepared for sharp, violent market repricings.
The artificial intelligence narrative is transitioning from the euphoric hype phase into the brutal reality of execution and return on investment.
As corporations begin to demand actual measurable revenue from their multi-billion-dollar AI investments, the market will experience severe volatility.
Do not let those swings shake you out of your long-term strategy. Understand that they are the natural, unavoidable friction of an economy undergoing a massive generational technological and geopolitical rewiring.
The volatility is a feature of the transition, not a bug. Maintaining a disciplined, unemotional approach to capital allocation is paramount in a high-variance environment.
I want to leave you with one final lingering thought to mull over as you analyze the markets this week. We spent a significant amount of time exploring the concept of the jobless boom driven by AI productivity.
It's a big one.
If artificial intelligence truly allows the world's largest, most dominant corporations to achieve unprecedented, record-breaking profit margins while simultaneously shrinking their human workforce and freezing the labor market, we have to ask a deeply uncomfortable, fundamental question.
Does a booming stock market actually mean a healthy economy anymore?
Or are we heading into a future where the markets soar but the people are left behind? Something to think about the next time you see the major indexes hit an all-time high.
It is, without a doubt, the defining socioeconomic and economic question of this decade.
Thank you so much for joining us in the jungle today. Keep your compass handy, stay curious, maintain your discipline, and we will catch you on the next deep dive.